All right, one more on this list, Angie's List. It's a business review site. This person started when they were 16 years old, which is great. Congratulations. However, Angie's List, like many of its IPO peers, is not profitable. Its actual loss in the trailing 12 months has been $51 million. Quite significant. The company's IPO paperwork revealed that in 2010, it had a $27 million net loss on sales of $59 million. So, again, it goes to show you a company that's experiencing losses and doesn't really have anything to offer investors. People just jump at the chance. Shares gained 25% on their debut in November 17th, but Angie's hurting as this year's warm and fuzzy environment for tech IPOs begins to fizzle. The stock is down 16% after less than 2 weeks on the market. That hurts. It really hurts. Now, with all these .com failures this year, you would assume that the media and the financial industry would sort of stop dead in its tracks and say, hey guys, this is really not benefiting investors. These stocks are all over the place. They're not really doing well. They're not essentially making all that much money. But no, everybody hyped up the IPO of Zynga, which is an online game company. And they continued to talk about it as this was the best thing since sliced bread. It says here in this other article, this was in Practical E-Commerce, it says Zynga's IPO was highly anticipated, despite the fact that in the days prior to going public last week, the company reduced its intended valuation by 50%. Okay. That should really be an alarm right there, because the investment bankers, they want to IPO at the highest price possible. So if they all of a sudden decrease the valuation by 50%, I wouldn't even walk away from that stock. I would run away. Okay? But let's read on. The stock was priced at $10 a share and closed on its opening day at $9.50. This past Monday, it dropped further to close at $9.05, despite the company being profitable. On Wednesday, the stock closed at $9.47. Says, according to Standard & Poor's Capital IQ, 7 U.S. tech IPOs have closed below the offering prices on the first day of public trading. More ominously, these 7 companies saw their stocks drop an average 52% after the IPO date. How do you like that? So this again goes to show how a lot of these .com companies are very fragile in that they're very sensitive to market events and events in their industry. It says, Zynga is almost totally dependent on Facebook for its revenue, and Facebook could change the terms of its agreement with Zynga or become a competitor at any time. For instance, in 2010, Facebook made all gaming companies convert to Facebook credits as currency to pay for virtual goods. As a result, Zynga, which was paying an average of 2 to 10% fees on virtual goods sold to gamers, had to start paying Facebook 30% of its revenues. How do we like that? Facebook has such a significant control over this company and its revenues that it's really not diversified as far as its channels for revenue. So I think that Facebook is another very much hyped IPO. Goldman Sachs has been working to get as many investors in as possible in the beginning, and supposedly when this comes out, it's going to be the biggest IPO ever. The more hype and the more marketing and the more excitement surrounding an IPO, probably the worse it's going to do after that initial rise upward. And all of this isn't really new. I think MySpace was a great example of how fickle internet users can be, where one day you had an amazing site that was filled with users. It almost couldn't even get any bigger, it seemed. It was making advertising revenue. People were very excited about it. And then Facebook came out, and pretty much overnight, MySpace became a forgotten story. And this wasn't only surprising to investors. Even News Corp lost significantly after they invested in it. It says 5 years ago, News Corp bought MySpace for $580 million. Then it was crushed by Facebook, leaving it at a fraction of its peak value. MySpace, once the world's hottest internet firm, has been sold to an online ad company for around $35 million. A fraction of the $100 million its parent company was seeking for the ailing social network, and billions less than its value 5 years ago. In 2006, Google signed a $900 million deal to sell ads on MySpace. By 2007, it had 300 million registered users and was being valued at $12 billion. But the social network was subsequently crushed by Facebook, which launched a year after MySpace. So again, this is another example how quickly a dot-com company can disappear. The sale comes as the new generation of internet firms are attracting sky-high valuations. Zynga, the online games developer, is planning an IPO that could be valued at $20 billion. So in this article, they're still talking about the Zynga IPO that we already discussed how well that went. My favorite part of the article is right here. Next year, Facebook is expected to go public. Analysts have expected that it could be worth $80 billion or more. Where do they get this valuation from? I'm just curious to know, where did this valuation come from? Now, of course, I understand that the investment banks coming up with this valuation are the same ones that have a vested interest in seeing this IPO do well, because they're already in on it. They have their investors in on it. As soon as it goes public, they all make a killing, unload the stocks onto the next. However, $80 billion, last I checked, the market cap for Goldman Sachs was about $88 billion. So you're telling me that this company, Facebook, which could lose all of its users just as quickly as MySpace did, is worth $80 billion? Seriously? Which would you rather own, Goldman Sachs or Facebook? I at least know my vote on that. It's definitely not Facebook. So that's just a little peek at the IPO situation that's currently happening, and I'm sure it's going to continue because people tend not to remember what happened just a few short years ago.